Well, greetings and welcome to the investment strategy brief for November 2025. We're going to get into the idea that there are some cracks in the markets, both a little bit on the debt side, but a lot on the equity side. Nothing too bad, but we'll get into sort of the causes of what's going on. Now, to set the stage, of course, it's always good to take a step back, look at what's going on in D.C. We know 2025 has been a year where we've seen big tariff changes, tariffs imposed on a variety of countries, and sort of stress that has come from that around the potential for inflation. We've had a big spending bill, a shutdown in the government. This is against a backdrop where the federal government's looking to basically become more efficient, but that translates to workforce reductions. And that also then also basically a setup for a deregulation. And, you know, some of these things are kind of nerve-wracking, others are sort of stimulative. And anyway, when we take a step back and look around the world, of course, we've got a lot going on. There's the ever-present U.S.-China competition, things that are going on there. We're going to get into fiscal trajectory, what's going on with our deficit and our debt. And then ultimately, of course, unfortunately, military hotspots that are active, Russia, Ukraine in particular. But then we're always mindful of other things that might be going on. So I kind of think of the geopolitical and political situation to be something that maybe net in the U.S. is a little bit stimulative this year, but with a lot of nerve-wracking sort of news coverage and worries that people seem to have about all the changes that have gone on. Anyway, turning to the economy, how's it all translating there? Well, the economy's held up pretty well. We're certainly back to trend growth after the reopening of the pandemic. This chart always reminds us that the consumer is a really important part of the economy, so we always like to focus in on how the consumer is doing. We know retail sales have held up. We know that sentiment and confidence surveys are indicating that there's some worry, there's some strain out there. And that's a little bit related to the job market. And so, you know, when we look at what's going on in the job market, and we had a pause with the government shutdown of data not being available, but the punchline is, which we've said before, is that we're pretty close to full employment. We're at an unemployment rate that's bumped up just a little bit, and we've seen a little bit of weakness in non-farm payrolls, but generally speaking, the job market is held up. What people are sort of focused on, though, are the changes. It's not quite as firm, and that certainly has the Fed's attention. Obviously, if the weakening continues, that's a problem. So as it relates to one side of the Fed's dual mandate, there's been a big focus on jobs. And back to the consumer, just in terms of the pattern that we've seen, when we look back to the decade, let's say, up to before the pandemic began, essentially you can think of the consumer portion of GDP growth to be about 1.75%, very round numbers, and that for the last couple of years it's been a little bit more than that, up to almost 2%. But then in the first half of 2025, basically that's been cut in about half. So think of it as in an annualized sense, so that the consumer has stepped back just a little bit, and it is a little bit in terms of sort of financial demographic, meaning that folks that are well off, with higher earning power and compensation and all that are holding up well, but people at the lower end of the sort of the pay structure, lower wage workers, there's a little bit more stress, and things are sort of, they've stepped back just a little bit. Now, as it relates to the sort of how this all wraps up to economic growth, I think the important thing to note is no one's really calling for a recession anytime soon. We've had pretty good growth and sort of an expectation of something close to 2% in 2025 and actually 2026. But if you look at what's going on for fourth quarter of this year, basically there's a view that things are going to slow down just a little bit in the fourth quarter and then sort of recover as we move into 2026. Now, I will say there are some quantitative metrics that are sort of pushing against that. There may be it may be not quite as soft as some have been forecasting, but that's something that we're watching for, is just a little bit of a slowdown. Now, back to the idea of the Fed's dual mandate, inflation, that's another data series that we've haven't seen an update on for a little bit with the government while the government was closed. And so we'll get an update soon, and that will be, think of it as a cumulative amount. They didn't do the surveys, then they're going to do the surveys for more recent periods, and we'll be able to at least track inflation over that full period. And again, think of it as it's been years since we had really elevated inflation. These are the consumer price index, the blue bars, the producer price index, the gray bars, each bar being a 3-month rolling average. And just think of it as you want it down towards that green line, which is the equivalent of the Fed's 2% target. And so the punchline here is it's kind of gotten there and then bounced back up and gotten there again and bounced back up. And so we're just watching. And I would say that the Fed, while still mindful of inflation, especially around the tariff issues that we talked about, essentially has leaned a little bit more towards this idea of the job market weakening some. And so what does that translate to in terms of Fed action? We've had a couple cuts recently. And then when we look at the futures market, that's where we can forecast what the market is anticipating in terms of Fed cuts. And it's been an interesting thing to watch, and an interesting thing in the sense it's been influencing the equity market day to day. And that is that the probability of a cut in December has sort of fallen below 50%, sometimes risen above 50%. Honestly, that number moves around as much as anything based upon commentary from the Fed. Let's say they're giving speeches or something like that. And the punchline is we don't really know what they're going to do. That's sort of part of the process, is they certainly aren't super transparent. But you'll get these signals, it's time for a cut, it's time to hold. And as this chart was produced, basically it's just above 50%, maybe around 60% probability of a cut in December. But gosh, a few days prior to that, it was down to like 45 or something. And so it's moving around a little bit. And our view, honestly, is we think there's more chance that they won't cut in December, but we'll see how things unfold when that happens. Now, I mentioned earlier the idea of fiscal trajectory. I feel like I'm being, quite repetitive about this issue. And as I think about it, essentially this is a bipartisan problem. So we've seen for both parties basically elevated deficit spending. So think about deficits, right around $2 trillion a year. It can be a little bit less if somebody's in power that doesn't want to spend as much, or it could be a little bit more. But almost like the debate that goes on between Democrats and Republicans around whether it should be 1.7 or 1.8 or something above 2, at the end of the day, all those numbers aren't that great when it comes to the debt, meaning that this deficit just sort of rolls into the debt, and the balance on our debt and our debt service costs keep going up. And really, you'll hear all kinds of experts around the industry say, hey, this is not sustainable. And so this is something that we're certainly focused on. We think others should be focused on. Of course, corporate and government leaders generally have been talking about it. But the key issue is when will Congress and the administration be focused on it? It's not that politically appealing to kind of focus in on this problem. In any event, though, we've been taking a lot of time to kind of look at different studies and ways to think about a path towards resolution. And so one way to think about it is to think about all these numbers as a percent of GDP. So these levels of deficit that I've been talking about currently are above 6% GDP. And we want to get to a number at some point that's at or below 3%. The current debt to GDP is about 122%. We want to see that number down in the 60 to 80% range, just again to keep everything healthy. And so ultimately what we hope to see is a plan, if you will, from the federal government to get us there. And ultimately, why it's not appealing from a political perspective is it requires austerity. And austerity can take two forms, probably will take both forms. On one hand, the idea of spending reductions, a cut in spending, and that could certainly include and involve entitlement reform. But then on the flip side, there's the idea of increased revenue through increased taxes. And again, the trick to that, most importantly, is that set of tax increases doesn't haircut growth. It's sort of self-fulfilling that it won't help if we charge a lot of taxes and then the economy slows down a lot. We'd rather have positive growth for sure. In any event, we're mindful of that, and yet the market, the economy, and we're about to get to the markets, have held up pretty well despite what is an increasing sort of debt burden for the government. So turning to markets, and related to this debt issue, is the level of interest rates. We've talked a lot about the idea that rates are well elevated compared to the lower times, especially during the pandemic. And I'd say another sort of modest and simple thing is that the shorter end of the curve, the left side of this curve, for the current level basically has come down a little bit in anticipation of those Fed cuts. And so that's something that we're keeping an eye on. But ultimately, as bond investors, these are pretty attractive yields. So it's a good time to have money at work in the bond market. And if you haven't had it there in a while, but you need the diversification, it's a good time to consider it. Now, as it relates to Fed cut cycles, one thing to look at is what does the bond market do once a cycle like that begins? And the punchline, this happens to track the U.S. Bloomberg aggregate. And this is basically taxable investment grade bonds in the U.S. And basically what we see here is that up to and then through the Fed cut cycle, that market typically posts a positive return. And it really relates to the idea that as the Fed cuts, market interest rates fall, prices on bonds go up a little bit, and so that's supportive. But it's notable. You can see that for this recent cycle, that hasn't quite been the case. And so on one hand, one could say, well, we'll probably see rates fall and the market move up, kind of in line with some of these other past cycles. But on the other hand, this may be a signal that investors are mindful of that fiscal trajectory and the challenges of the U.S. debt, meaning investors, despite what's going on, they want higher yields to sort of compensate them for the risk around U.S. government debt. So again, that's something that we're focused in on. We actually are in the midst of developing our outlook for 2026. It'll be released in early January, and that'll be a topic for sure, that fiscal trajectory. Now, as it relates to the equity market, so turning to the equity market, I think I want to start with the idea of looking at how the makeup of the market has changed over the years. So if we look back to 1985, and we just grabbed basically the top 10 companies in the market, and back then those 10 companies represented just over 20% of the S&P 500, just to give you a sense for their influence. And we see companies like GE, AT&T, a bunch of oil companies, General Motors, IBM. But when we look forward to today, essentially you've got JP Morgan and Berkshire Hathaway, and all the others are tech or tech related, and their weight in the index is in the high 30s, so approaching 40%. So you see two things. Number one, these big companies are more influential. Number two, there's a significant leaning towards these big tech-oriented companies that we keep talking about, right? So where tech goes, the influence of tech on our economy, all of that basically relates to market performance, meaning the two are interrelated. Now, the idea of technology, of course, is a part of our long-term investment themes. We've talked a lot about it, the idea of productive competition, the idea of new patterns of consumption and the new consumer, if you will, shifting demographics and things like a focus on longevity, or the idea of strategic resources being really important to stay focused on energy, water, food. And then ultimately, though, this idea that transformative technology is influencing our world. And of course, there's nothing more significant in today's environment than artificial intelligence, right? So we've talked a lot about that. We've written a lot about it. We've written about how it's going to affect the job market, ultimately to a net positive. We've written about how there's going to be an increased focus on how AI will influence productivity and profits for companies that utilize it or deliver services around it. We've talked about some early wins in the area of healthcare, cybersecurity, and even finance. And so we know that AI is really super present. And we've been looking at studies and things on how AI is influencing things. And so, for example, what we see right now is 45% of adults are using AI regularly. A third of them using AI at least once a week, and 10% using it daily. Now, this is another metric that I think is quite striking, the idea that when somebody's at work using AI, they estimate that they're saving 5% of their time each week. And these are really early days, right? So the idea that we can see what is really a pretty significant time savings right out of the gate is pretty interesting. Now, companies are saying, there's probably about a tenth of the companies out there saying that they have a mature implementation of an AI strategy in place. 80% say that AI is going to reshape their business over the next 5 years. And so ultimately, what we're starting to watch and think about is forecasting basically how productivity and ultimately growth rates might be higher as a result of the use and deployment of AI. Now, ultimately, this is all, I mention all this to say this is some of the foundation of what I would call the tailwinds to the equity market, right? And so what we've seen ultimately is really strong profits and earnings. So the S&P 500 with a profit margin, round numbers of around 13%, is the highest that it's been in over 15 years. There's just a consensus that AI is having a positive sort of influence on things, and ultimately, the idea that we're seeing strong earnings and earnings growth that keep holding up. Now, what does that mean when it comes to where the markets go? Well, one of the things we wanted to look at was, you think of it as the components of returns, right? And so one component is labeled in this chart multiples. So that's the idea of the PE ratio expanding, sort of in reaction to this optimism. And so when you see that number positive, that means the optimism, it's not earnings growth or directly or dividends or whatever influencing the return. It's basically optimism around what's going on. And so what you can see across this complex of global returns is that the multiples, when we look back at longer periods, it was kind of a positive influence on the U.S. You can think of our development of our tech industry, our tech sector. And so that kind of makes sense. But then when we look over the last couple of years, so last year and then year to date this year, the multiple expansion is really having a significant role. But interestingly, it was a big contributor here in the U.S. last year, but not as much, still there, but not as much in 2025 year to date. And, I would just say, hey, when that happens, we see multiples, PE ratios get elevated, and we've been mindful of that, right? And so one of the things we've done is to talk about the idea that there may be a pullback. We've been talking about this for just almost a month. And the idea is to say, look, the market levels have been very richly valued. We're probably going to see some kind of pullback in the market. We're really not market timers, but it's just about observing the patterns, right? And ultimately, what we had been talking about is to be ready for that from a few perspectives. Sort of emotionally, don't get super spooked. Number two is if it's a time where your asset mix has gotten sort of out of sync, you can rebalance. That's a good time to do that. Or if you happen to be an investor that has chosen to de-risk and take some money out of the equity market, for example, while equity markets are elevated, that's a good time to do it. But we were talking a lot about that, but then ultimately we've seen the market roll over, meaning the pullback has begun in a way. And I'm not sure it's going to go too much farther, but think of the S&P 500 as I record this as being about 4% off its most recent record. And the tech sector, just to sort of emphasize sort of the volatility, if you will, both positively but sometimes negatively of that tech-oriented area, is off almost 10%. And so, the punchline here is that we've seen a little bit of a pullback, and yet when we look at this relative to patterns of past, in this chart, it happens to be the first year of a presidential cycle. We're kind of coming back towards the long-term average year to date of that return, and now we've sort of fallen back below what I'll call the Trump 1.0 administration, the first year of that administration. And so here, essentially, not a surprise after obviously the April lows, big recovery, now a little bit of a give back relative to what's going on. And again, I think it relates to, while on one hand, valuations being pretty rich, but also that nervousness that we've talked about in the market. People are excited to see all this going on with AI and the earnings growth and all that, but they're sort of looking forward and worried that it won't continue. In any event, when it comes to valuation, the PE ratio today compared to its 10-year average, it was up in the mid-20s roughly, and it's coming back down below 20% now with this change. And so ultimately, the takeaway is, hey, we've seen a little bit of retrenchment in the market, but it's still kind of richly valued by historic standards. And ultimately, it relates a lot, again, to the idea that AI and tech-oriented focus is there and actually generating value, generating earnings that ultimately people are willing to pay for in the hopes of seeing more. Ultimately, that's sort of the recap of what I wanted to get into, the nervousness, especially in the market, the effect of that. But in this session, I wanted to finish up and highlight something that we publish weekly called Stifel Bits. This is a publication. It's a little bit more lighthearted, and it's intended just to share some interesting facts and figures. It's a little bit of a play on food, but ultimately we do this each week, and I wanted to mention it in part because when we monitor who's reading our work, this is by far the most popular publication that we produce. And so in this episode, I just wanted to mention a couple of things that I thought were kind of fun. The first is the cost of a luxury hotel that's going up a bit. The second is a survey that was sort of comparing human joke telling to AI joke telling, and I assume it's a blind survey that 70% of the people surveyed liked the AI jokes more. And then ultimately tracking things, and this relates to the commercialization of space, but the idea that the Starship rocket from SpaceX has had a number of test flights. Those are the kinds of things that you're going to see in Stifel Bits. And so I think in each of these videos, at the end, I'm just going to go grab a few interesting facts just to sort of share the work of Stifel Bits as we go forward. So anyway, listen, we're almost at the end of 2025. I can't believe that I'm saying that. So I'll look forward to coming back to you in December. But thanks in the meantime for checking out this month's edition, and we'll see you then. Thanks.